Hello and welcome. Today, we're diving into the fascinating world of market microstructure. Think of it as looking under the hood of financial markets to see how the actual trading process works. It's about understanding how tiny interactions between buyers and sellers shape prices, liquidity, and the overall health of the market. Especially now, with fast electronic trading and tons of data, getting this microscopic view is crucial. We'll focus on three key areas: high-frequency trading, the limit order book, and market liquidity. First up, high-frequency trading, or HFT. This uses super-fast computers and smart algorithms to trade in fractions of a second. HFT isn't one single strategy. It includes things like market making, where firms provide buy and sell quotes, or arbitrage, trying to profit from tiny price differences. HFT is a big player, often responsible for a large chunk of daily trading volume. But is it good or bad for the market? Well, it's debated. Supporters say HFT adds liquidity by keeping bid and ask prices close together and helps prices adjust quickly to new information. Critics worry about transient liquidity, orders that appear and disappear in milliseconds, potentially misleading traders. There are also concerns that some HFT strategies might disadvantage slower, traditional investors. Regulators are keeping a close eye on HFT to ensure markets remain fair and stable. Next, let's talk about the limit order book, or LOB. This is essentially the market's real-time diary, listing all the pending buy orders, bids, and sell orders, asks, for an asset neatly organized by price. By watching the LOB, we can get clues about supply and demand. What do we look for? We look at the volume of orders at different prices. High volume suggests strong interest. We look at trade sizes. Large trades might signal big institutions, while small ones often mean retail traders. The gap between the best bid and the best ask price, the bid-ask spread, tells us the immediate cost of trading. A narrow spread usually means good liquidity. We also consider the depth. How many orders are waiting beyond the best prices? This shows how much the market can absorb without big price swings. Finally, tracking the flow of new orders helps gauge buying or selling pressure. Researchers use complex models, even AI, to analyze the LOB and predict short-term price moves. That brings us to our third topic, market liquidity. Simply put, liquidity is how easily you can buy or sell a large amount of an asset quickly, without drastically affecting its price. It's a vital sign of market health. Good liquidity means tight spreads, lots of orders available depth, and the market bouncing back quickly after big trades, resilience. Why model liquidity? It's essential for designing trading strategies, managing risk, and for regulators overseeing the markets. We need to distinguish between market liquidity risk, the risk of trading becoming difficult or expensive, and funding liquidity risk, the risk of not being able to meet payment obligations. Models look at spreads, depth, volume, and the estimated cost of making large trades. In today's world, with trading happening across many different venues, modeling liquidity gets even more complex. So you see how these pieces fit together. HFT strategies heavily rely on data from the limit order book. In turn, HFT activity significantly shapes that order book and influences overall market liquidity. It's all interconnected. Modern analysis increasingly uses machine learning to find subtle patterns in this complex data. Understanding market microstructure. The interplay of high-speed trading, order book dynamics, and liquidity is fundamental for anyone involved in finance, from individual traders to large institutions and the regulators who oversee it all. It helps us navigate and even shape the future of our financial markets. Thanks for tuning in.